Hello friends, welcome to the lecture on Advanced Microsoft Excel. Today I am covering Chapter 4, Applied Financial Analysis and Forecasting Financial Statements. I am Ashwini Bansal, your mentor for this session. In this chapter, we are discussing financial analysis, DuPont analysis, leasing decision, financial segregations, equity analysis, and chart creation. First, financial analysis. Financial analysis will offer focus on the income statement, balance sheet, and cash flow statements. Excel allows us to use various functions and even simple mathematical calculations can be performed for financial analysis, equity analysis, leasing decisions, and the list going on. The main part of financial analysis is reports. Report means balance sheets. So we are discussing about an important aspect. First one is balance sheet. Balance sheet means asset and liability. That means asset equal to liability plus shareholder equity. For calculating the various concepts in a balance sheet, we use various elements. First, like arithmetic operations like addition, subtraction, multiplication, division, etc. Second one is conditional operators like greater than, less than, greater than equal to, less than equal to, etc. Cell reference. We use cell reference in an Excel sheet. Range reference. We can use range like C1 to C10. That means C1 colon C10. Named reference. For creating a name reference, we use name manager in a Excel sheet. That can be done through formula tab in a Excel sheet. Strings. Strings are always used in double quotation in a formula. Throughout, we use worksheet functions for calculating various aspects in a balance sheet. And parentheses. Every formula has its own set of arguments which are written in parentheses. Parentheses are also used to change the order of the calculations. We use various functions to calculate the financial aspects of balance sheets like function. What do you mean by function? Function is a built-in tool that you use in a formula. For example, today function. Today function is used for date and time. Mode is a remainder, and absolute function ABS. Let's take an example. We are just implement the today function in Excel sheet equal to today bracket start bracket close. Automatically date is mentioned in a activate cell. Then equal to ABS bracket start. Let's say -4 is my value, or you can use any reference here. That is automatically converted into 4. And third one is mode. Equal to mode bracket start your number, that is just like 100 is my number, and dividend divisor is 5. Your output is 0 because 5 is a divisor of 100. And we can change the value here like 3. 99 is the digit, but here we can get an answer that is 1. That is the remainder. Mode equal to remainder. Categories of functions. There are various categories in an Excel sheet like financial function. Financial function just like future value, present value, IRR, internal rate of return, etc. Date and time function just like today function, now function, month function, etc. Math and trigonometry functions. Some product are the example of math and trigonometry functions. Statistical functions like count, average, mean, median, mode, etc. Lookup functions like itself lookup is a function. VLOOKUP, V means particular lookup. H lookup, H means horizontal lookup. Text function like trim function, proper function, left function, right function, etc. Logical functions like and, or, if, nested if, etc. User defined function, we are using any function within a function like if with and or. Engineering function like complex and delta, and last one is cube like cube sets. These all functions are available in formula tab in a Excel. Let's move to Excel formula tab. Then these all are functions, function categories, function insert function, that is the dialog box of the functions, and here we can select a categories, like they have overall categories available here, and if we select all, there are n number of functions related to various categories. And these all functions are also available in function libraries differently, like financial, logical, text, date and time, lookup, mathematical and trigonometry, and various other functions. Let's discuss few various balance sheet items. Like first one is asset. Asset, current asset is a part of asset. Current asset includes cash, accounts receivable, and prepaid expenses, etc. Second one is long-term investment and other assets like investment in companies. Third one is fixed assets like property, machinery, plant, furniture, etc. Intangible assets like goodwill, patents, etc. Total asset means total of current long-term plus intangible assets. Second term is liability. Liability includes current liability like account payable and short-term debts. Second one is long-term liabilities like long debts, and liability equal to total of current liabilities plus long-term liabilities. Third one is equity. Retained earning like company's cumulative net income or losses. Owner equity, and total equity equal to total earning plus owner equity. And total equity and liability equal to total liabilities plus total equities. Let's take a simple example, case study 1. For a new business, you want to buy a small office. You have 5 lakh which you pay as down payment for office. Additional 20 lakh you borrow is your liability. Assume you have borrowed from your friend or relative as interest-free loan. Like financial obligations are like liability and assets. Loan outstanding is amount value is 20 lakh. Owner equity 5 lakh, and total liability and equity equal to 25 lakh. Office purchased by person is 25 lakh. That is a simple balance sheet. Let's take an example. Example of financial aspects. Revenue of company A is 50,000 and company B is 40,000. according to you, which company is better? The answer based on earning is that company A is better because it earns more. But there are some other concepts like, now suppose the capital employed by company A is rupees 4 lakh and company B is 3 lakh. Based on this new information, we shall derive profit as a percentage of capital. Employed company A equal to 50,000 divided by 4 lakh into 100 means 12.5%. Company B 40,000 divided by 3 lakh into 100, that means 13.33%. Company is better than company A because on the above ratio. Thus, ratio helps us to convert figures into logical percentage. Thus, ratio change the financial aspects. So we can discuss more ratios like current ratio. These ratios show the ability of a company to pay its current financial obligations. Current ratio is calculated through current asset divided by current liabilities. Let's take an example. That is a predefined balance sheet as on 31st March 2015. There are various data available in this balance sheet. We can just calculate the current ratio equal to current assets, that is E11 to E14 bracket close for sum and divide by sum of current liabilities, that is B14 to B15. That is your current ratio. Next one is quick ratio. Quick ratio used to examine whether firm has taken cash or cash equivalent to meet current obligation without resorting to liquidity, non-cash assets such as inventory, and also known as acid test. Quick ratio equal to quick asset divided by quick current liabilities. Quick asset means current assets minus inventory plus prepaid expenses. Let's take an example of quick ratio. Quick asset equal to sum of current assets minus sum of inventory plus prepaid expenses. And quick assets equal to 262. Quick ratio equal to quick assets divided by sum of current liabilities. That is the output of quick ratio. Next is leverage solvency ratio. This ratio shows dependency of a firm on outside long-term finance. There are various ratios in this solvency ratio. That is, first one is debt equity ratio. Second one is debt total fund ratio. Next is liability coverage ratio, turnover activity ratio, inventory turnover ratio, average collection period, and fixed asset turnover ratio. Let's discuss one by one. First one is debt equity ratio. Debt equity ratio equal to long term debt divided by shareholder funds. Debt loan equal to secured loan plus unsecured loans, and shareholder funds equal to equity plus preference capital plus reserve and surplus, subtract fictitious asset and accumulated losses not written off. Let's take an example. Long debt means equal to secured loan and unsecured loan. Sum of secured loan and unsecured loan, that is B7 to B9. Output is 181. Shareholder fund equal to sum of equity, preference, reserve, surplus, etc. And debt equity ratio equal to B16 divided by B17. That is converted into percentage. Use the decimal places if required. Next one is debt total fund ratio. Debt total fund equal to long term debt divided by total funds. And ratio of total debt funds equal to G16, that means total long term debt divided by total fund. That is converted into percentage. This is required. Next one is liability coverage ratio. Liability coverage ratio is used for calculating to determine time a company would take to pay off all its liability for internal generated funds. LCR equal to internal generated funds divided by total liabilities, and the internal generated funds equal to equity plus preference plus reserve and surplus. That is the balance sheet. Internal generated funds equal to sum of equity, preference and reserve and surplus, that is means B3 to B5. LCR equal to internal generated funds divided by total liabilities. That is the output of our LCR ratio. Next is turnover activity ratio. That allows to examine whether total amount of each type of asset a company owns is reasonable, too high or too low in light of current and forecast operational needs. First, that is used for more asset acquired imply high interest and low profit, and leisure assets implies operational not as efficient as possible. Third, activity turnover ratio used to assess efficiency with which company is utilized its assets. And last one, related to level of activities represented by sale or cost of goods sold. Next is inventory turnover ratio. Measure number of times inventory turnover in a year or number of days of inventory held by company to sales. Inventory turnover equal to net sales divided by average inventory or cost of goods sold divided by average stock. Let's take an example. That is the income statement of 31st March 2015, and we use a formula in this Excel sheet. That means inventory turnover ratio equal to net sale. That means C18 divided by E10 inventories. Enter. That is your output of inventory turnover ratio. Average collection period. It represents duration a company must wait after making sales before it actually receives cash from its customers. Average collection period equal to average receivable divided by average sale per day, or average receivable into 365 means year divided by sales. Let's take an example. Equal to receivable, that is E9, multiply by 365 and divide by sales, that is C18. That is a average collection period, that is 76.310. Next is fixed asset turnover ratio, FARTR. It helps to measure effective utilization of fixed assets by company and used to compare fixed asset utilization of two firms. FATR equal to net sales or cost of goods sales divided by fixed assets. Let's take an example. Fixed asset according to the balance sheet equal to, that is a fixed asset, E3 and E4, equal to E3 and E4. E3 and E4. That is 229. Next, cost of goods sold equal to C19 divided by fixed asset, that is D42. Your output is 3.12. Fixed asset turnover ratio is 3.12. Profitability ratio. This ratio indicates company profitability in related to other companies, internal comparisons with its previous year performance. First one is gross profit ratio, second one is net profit ratio, third one is return on investment, and last one is valuation ratio. Valuation ratio are divided into three parts. We can discuss later. First is gross profit ratio. This ratio represents cost of production and help in understanding properties, proportion of raw material used and direct expenses incurred in overall production process. That is gross profit divided by net sales. Gross profit margin ratio equal to gross profit divided by net sales. And gross profit equal to net sale divided minus cost of goods sold. Move to Excel sheet, that is a balance sheet, and GP equal to net sale minus cost of goods sold, that is 190, and margin ratio equal to GP divided by net sales, that means C18, and your output is 21%. Gross profit margin ratio equal to 21%. Net profit ratio. It takes into account not only cost of production but also administrative expenses like salary, selling and distribution overheads. Net profit margin ratio equal to net profit divided by net sales. Let's take an example. That is a common balance sheet we use in every example. Equal to net profit after tax, that is C35, divided by net sales, that is C18. That is the output 5.75%. Net profit marginal ratio equal to 55.75%. Next is return on investment. This ratio indicates efficiency with which company used its capital. Return on investment equal to EBIT multiplied by 100 divided by capital employed. And capital employed equal to equity plus preference plus reserve and surplus plus debt minus fictitious assets plus non-operational assets. EBIT is given in the balance sheet, that is C29 143, and capital employed is equal to sum of equity plus preference plus reserve and surplus plus debt, that is B3 to B9 minus fictitious asset plus non-operational assets that is not defined in the balance sheet. That's why we can use here minus 0 plus 0 whole bracket, and your output is 566. And return on investment equal to EBIT multiplied by 100 divided by capital employed, and that is your output. Return on investment equal to 25.26%. Next is valuation ratio. Valuation ratio are divided into three parts. First one is earning per share, that means EPS. Second one is price earning, that is PE. And third one is PEG, that means price earning growth multiples. First one is EPS. It represents total earning of a company available for distributing among equal shareholders, evaluates performance of company shares over a period of time. EPS equal to net profit available for equity shareholders divided by number of equity shares. And next is price earning multiple. It is the simplest method of comparing different stock at a point of time to make investment decisions. That means market price per share divided by EPS, earning per share. And last one is price earning growth multiples. An extension of price earning which takes into account growth rate of the company. That means price earning divided by growth. Price earning growth multiply equal to price earning divided by growth. Let's take an example and move to Excel sheet. In this example, company A, company B, market price given, that is 200 each, EPS that is 10 and 20, growth rate is 5% and 2%. Calculate the PE ratio, that is price earning ratio, means market price per share divided by EPS. equal to market price divided by EPS. And same in this section, and your output is 20 and 10. And next one is EP, price earning growth multiplier, that is equal to E divided by growth ratio, that means P5 divided by B4. And same is displayed here, that is 4 and 5 is the output of EPG multiplier. Next is dual point analysis. Dual point analysis help to break down the return of equity, that is ROE, return on equity. Return on equity is a financial ratio that shows you how well the management has created value for shareholders. Return is made up of two numbers, that is net income and shareholder equity. And return on equity equal to net income divided by shareholder equity. Dual point question. There are three questions that the dual point analysis can help your answer. First is the company increase margin? Second is the inventory turnover increase? And third one is leverage being used? We find the answer with the help of three steps. Dual point analysis steps are net profit margin, asset turnover, and equity multiplier. That means return on equity equal to net profit margin multiplied by asset turnover multiplied by equity multiplier. Net profit margin equal to net income divided by sales. Asset turnover equal to sales divided by total assets. And equity multiplier equal to total assets divided by shareholder equity. Let's move to Excel sheet. That is the data by default mentioned in an example. That is company A, revenue, EBT, EBIT, interest, income tax, net income, asset, shareholder equity. These are mentioned in a Excel sheet, and we use the data for calculating a net profit margin first. That is net income divided by sales equal to net income divided by sales. That means B7 divided by B2, and your output is 5.5. By default, the percentage sign is not mentioned in the Excel sheet. We can convert with the help of this particular sign. And next is asset turnover. That means equal to sales B2 divided by total asset. That means B8. And your output is 1.764. And equity multiplier equal to total asset divided by shareholder equity. That is 1.641. And last one is ROE, that means return on equity equal to product of all three. That means we use a formula for product. All three, and your final output is 15.8%. Return on equity equal to 15.8%. Next one is leasing. Leasing is a common method for financing properties, facilities, and equipments. Lease are contract between an asset owner, means leaser, and the user, that means leasee. Leaser is a owner and leasee is a user. Let's discuss a case study. Suppose we want to buy a server and its cost is 1,75,000 and leasee pay are 45,000 with annual rate of 8%. All the calculations are done through Excel sheet. Let's move to Excel sheet. It's 75,000. Lease amount, that is 45,000 per annum, and interest rate is 8%. Here there is a one more concept, that is purchase of particular server. The amount of purchasing is 1,75,000. We can discuss about the amount of purchase and lease, which is better for us. And to know this, we use a formula here. That's lease amount equal to 45,000. Same last year, same last year, and same last year. And sum of and net present value equal to C6 plus net present value. Rate of interest is 8% and values are C7 to C9. That is your output of lease. If we use a server for more than 3 years, that is your amount. Next is NPV, that is equal to B2, and next cell D7 equal to NPV. Rate of return, that is 8%, means B3. Fix the B3 cell through F4. Comma value, that is D6. Bracket close. Enter. Then according to the relative cell reference, drag and drop, and last one is equal to sum bracket start. These all numbers. These all are equal, means lease and your net present value is equal. These amounts are equal, and what to conclude? Equal to if B10 purchasing amount is less than C10 leasing amount, then purchase, otherwise lease. That is the conclusion. Press the enter, you can go to your answer. That is lease. Lease is better than purchase. Financial significance is your next topic. Financial significance are action or omissions intend to hide or distort the real financial performance or financial conditions of an entity. That is just like a trick. Let's discuss a one most famous case of fraud, that is Enron case. In Enron case, the table in Excel shows Enron figures for 5 years in a row. Enron is a name of a company whose rankings is increased but profit decreased. Figures cannot show this concept. That is done through charts. Let's move to Excel sheet. That is the Enron figures, year 96 to 2000. Sales, gross profit percentage, net profit, net profit percentage, and rank. Rank is first rank is 94 and last rank is 7. That is a better than first rank. And gross profit percentages decreased and same net profit percentages decreased. To find out the conclusion, we use a charts. In this case, first draw a sales chart. First go to insert tab, then lines, then you can draw any chart. Select your data, line chart, let's say this line. That is a sale chart. Sale is increased. But why profit is decreased? If sale is increased and rank is also better, then why gross profit percentage or net profit percentage is decreased? That is a real fraud. With the help of charts, we can easily find out the result. We'll easily change the formatting of charts with the help of these three tabs: Design tab, Layout tab, and Format tab. In Design tab, we can change the chart types, like this one is a chart type, then click OK. Your chart is changed. And next is row to column and column to row. If your data series is more than one, then you can select this data. And select data means you can edit your data, you can change your series here. Next one is chart layouts. There are various layouts available in the Excel sheet. These are by default layouts. And next one is the chart style. Move chart. If you can move your chart from one location to another location, then we can use this option. And next one is layout. Layout chart area. Your plotted area is according to various concepts. That is a chart area. Format selection, which format you can select in this window. Border color, border shape, styles, shade. Those 3D formats. There are various formats in this available window. Then you can insert a picture, shapes, text box in your charts. Chart title, that is the topmost area, and that is sales, millions, dollar. Axis title, that is your bottom area. If you can enter the axis title, you can select this portion like any Excel title. If you cannot, then select none. Legends, there are various legends show at a right, that is by default show at a right. Data labels, these are data labels. These are the values which are mentioned in your data series. Data table, you can reflect your data table below, side, anywhere. That is your data table. If you can deselect this option, data table is removed. Axis, that is by default axis available in your chart. Grid lines, you can change your grid lines accordingly. That is your background grid lines. That is your grid lines. Plotted area is same. You can plot your chart in which area. Trend line analysis, line and up down bars are the analysis techniques. And next one is formats. There are various formats available in the chart. First one is same format section. Second one is same shape style. If you can change your shape style, then you can change accordingly. And these are the colors according to your shape styles. Word art, if you can use any word in your chart, you can change this option with the help of word art. These all are words in your chart. And next one is arrange. Arrange, if you can arrange, bring to front, send to back, means more than one chart, and you can bring to particular chart in front and particular chart to back, then you can select this option. And if you can group this chart, you can select this option. If you can rotate any words, you can use this option. Alignments, you can align any concept with the help of these options. And if you can increase or decrease the size of your chart, click on height or width. These are three tabs available in the charts to design, layout, or format your charts. These all are the chart style techniques, chart designing techniques, chart layout techniques. Let's move to Enron case. Enron case, we prepare one more chart, that is percentage of GP, and then click Control and select NP. Insert chart, a line chart for this option. Line scattered chart, stacked chart, sorry. That is a gross profit and net profit lines. According to your first year, your last year gross profit and net profit is decreased. That is the analyzing case of Enron case. According to this chart, we says that something very wrong in a financial data. It would not be very difficult for a learner, investor, and a good auditor to recognize the anomalies in a data. And according to an investor point of view, the investment in an Enron company is not very good because his rank is increased and net profit and gross profit is decreased. That means Enron company makes many frauds with our shareholders. These all are financial segregations. Next one is equity research. Equity research is a study of company, its financial statements, products, management, and take a decision about investment. Valuation models. Valuation methods. Valuation model used time value of money principle or simple market principle to value assets. Stocks and share or the perceived value of future benefits. Methods. First one is asset and adjustment method valuation. Second one is dividend model. Third one is market model. And next one is free cash valuation. Next is market method. Market method, that is stock market and earning method using share price, earning per share, and price earning per share. Market value equal to number of shares multiplied by share price. Let's take an example. Number of share is 10 and market price of per share is 100. That means 100 multiplied by 10. That means 1000 rupees of is a market value. Let's move to next slide. Dividend growth model. The dividend growth model links the value of a firm equity and its market cost of equity by modeling the expected future dividend receivable by the shareholders as a constantly growing perpetuity. Let's take an example in an Excel sheet. According to a dividend growth model, suppose Big D Incorporation just pay a dividend of 30. It is according to the dividend growth model. Suppose Big D Incorporation just pay a dividend of 30 rupees. It is expected to increase its dividend by 2% per year. If the market requires a return of 15% on assets of this risk, how much should the stock be sold for? Here there are various concepts used in the formula, that is P0 equal to D0 bracket start 1 plus Z bracket close divided by bracket start R minus G bracket close. P0 means current stock price, D0 means current dividend, G means constant growth rate, R means annual required return of rate of return, and P0 we can calculate, that is current stock price. Here D0 mentioned, that is 30. P0 we can find the P0. G constant growth rate is 2%, and annual required rate of return, that is RRR, that is 15%, and 2% means 0.02 and 15% means 0.15. We can find P0, that means current stock price. According to the formula, equal to D0, that is 30 bracket start 1 plus G, that means 0.02 divided by R minus G bracket close, and then enter. Some reference is missing in this formula. Let's check this reference error. According to this function, there is one option missing, that is D0 multiplied by this. And in this formula, we can change the concept to multiplication. That is your output. That means current stock price equal to 235.39. These value methods are divided into some parts. First one is stock price sensitive analysis growth percentage, and second one is stock price sensitive analysis expected returns. First one is growth percentage. We shall perform a sensitive analysis to see how the change in growth percentage affect market price of shares. And second one is expected return. We shall perform a sensitive analysis to see how the change in expected return affects market price of share. Let's take an example. In this sensitive analysis growth percentage, we have expected dividend as 2. Required rate is 20%. Means D1 is 2 and RRR is 20%, that means 0.2. You can find out the dividend, means current stock price, and growth rate according to the percentage, that is first year 0%, second year 1%, third year 2%, and next year 3% onwards. Find the price equal to F5 dividend in first year divided by G7 minus D12, that means constant growth rate. We can fix the values F5 and G7. Enter, and that is your output of growth percentage according to your growth rate. First year 10, second year 10.52, next year 11.11, and next year 11.76 according to your 1%, 2%, 3%. That is year wise, 1 year, and your percentage is changed, growth rate is changed. Next one is expected return. Next one is sensitive analysis, expected return. In this example, we expected dividend as 2%, and growth rate is 5%. Means dividend in first year is 2 and constant growth rate is 5%, that is 0.05. Annual required rate of return is 5.5% and 6%. Current stock price equal to F5 divided by B12, subtract constant growth rate, that means G6. Same, fix the cells. If you can use relative cell reference, and that is your output 400 and 200 according to the required rate of return.